Speaker of the day, Shri Pinakin Desai, Vice President Chetan Shah, Joint Secretaries Narayan and Sunil, Treasurer Manish Sampath, respected seniors, professional colleagues and young friends. Good evening everyone and welcome to this first lecture meeting of the BCAS year 15-16 on recent developments in international taxation. Since last several years, international taxation has been a topic raging with controversies on legal interpretations, divergent judicial pronouncements, amending of the law to circumvent Supreme Court decisions which were in favor of the SSE, and also increasing in a very big way the reporting obligations. India has been the hotbed of controversies. Apparently, nearly 80% of global transfer pricing litigation is going on in India. Take backlog, the length or the cost of tax litigation, India remains unbeatable. Add to that the HSBC Swiss bank account related orders and demands, the Black Money Act, place of effective management law and base erosion and profit sharing issues thrown into the ring. Our country is possibly close to achieving the singular distinction of being the most tax litigious nation in the world when it comes to passing tax orders that border on creativity and imagination, for making numerous laws that are based on deeming fiction, and for being unable to arrive at a workable dispute resolution mechanism. And in 2015, we have gone back 2 spots in the ease of doing business in India, from 140 to 142 out of 189. Just the other day I was speaking to an Australian expat, and he said, along with Make in India, what is needed is make it easy. Therefore, it's only befitting that we have our first lecture meeting of the year after the founding day on international taxation. The speaker of the day is one of our favorite amongst the great masters on the subject, Shri Pinakin Desai. He has not only been a president of the BCAS in 1987-88, but has been a perennial friend, philosopher and a guide for the Bombay Chartered Accountants Society. Pinakin Bhai has been in professional practice for over 40 years. I have known him as an exemplary professional, always available to help, a very gentle and humble human being. He is a partner in Ernst & Young and heads its Tax and Knowledge Solutions group, which provides technical support and develops tax solutions and strategies. Before joining the Ernst & Young India, Pinakin Bhai was a senior partner in Pinakin Desai and Company, was also visiting professor at Narsi Monji College of Commerce and Economics, a leading college in Mumbai, for more than 8 years. After being the president at BCAS, he has served as the chairman of Taxation and International Taxation Committee for several years, and one special distinction that a lot of us know of and for which he is well known is about contributing more than 30 technical papers at the residential courses of the society. And add to that, we are looking forward to his paper at the next ITF conference, which is happening in August, on poem. He was also the Vice Chairman of the Taxation Committee of the Indian Merchants Chamber, and Honorary Treasurer at the Forum of Free Enterprise, and Independent Directors on several company boards. Over the years, he has also presented many research papers at seminars and conferences of the ICAI and other professional and trade bodies on various subjects of professional interest. Pinakin Bhai, we are delighted to have you speak to us once again, year after year, and on behalf of everyone here and as a mark of our appreciation and regard, I'll request Chetan to present a memento on our behalf. to you, sir.
The dignitaries on the dais, Sri Arvind Bhai, and my dear friends. Congratulations, first of all, to the office bearers, and I am sure under your leadership, this year will be as good, if not better than what it always was. We have today as the subject recent developments in international taxation. And I thought we can cover up what all that has gone by over the last 6 to 12 months. Some of the controversies or some of the developments are more recent, and I think let's begin with a development which is right in the news, India-Mauritius DTAA. Mauritius became quite favorite with the investors in India on account of a very favorable treaty that we have. It is under negotiation for more than a decade now, as per the news, or there always was a desire to renegotiate, but somehow the mission didn't succeed. As we now see, there is a very strong possibility, or it's almost on the cards, that the treaty has been renegotiated and the renegotiated treaty will be available to us. It's a matter of guess as to what it would be. If the guesswork is correct, someone would say that the limitation of benefit clause will be inserted. Will it be an objective consideration like what we have for Singapore, namely that incur certain expenditure in a country? If we do that, probably we will be giving a fillip to their economy comparable to our own economy. There is also a suggestion that together with the objective LOB, there could also be a subjective consideration. Along the line of Singapore, it may be provided that the benefit of the treaty will not be available if an attempt has been made to secure the benefit of the treaty. Someone would come up and say that it's only the real estate company which will be captured. So if a Mauritian company is deriving value from real estate in India or through an Indian company which is having real estate, then the transfer of shares would be captured. There is also a guesswork that investments which have been made prior to 2017 would be grandfathered. CNBC today also goes on to say that maybe the short-term capital gain would come up for India taxation, but the rest will still be protected. We do not know what it would be, but in a week or 10 days' time, probably we will have some more confirmed news. We should remember that as of today, India-Singapore Treaty has been very largely tied up with the India-Mauritian Treaty. Protocol to India-Singapore Treaty provides certain benefits contingent upon what we see on India-Mauritius DTAA. Based on, therefore, what we get for India-Mauritius, we will also need to take a view as to how far is the India-Singapore Treaty affected or influenced on account of India-Mauritius Treaty. Something else which is in the news is the amendment to Section 195, subsection 6 in the last Finance Act. Section 195, subsection 1 provides that there would be a tax withholding obligation on the part of a payer if the amount which is being credited or paid to a non-resident is liable to tax in India. It should be income chargeable to tax in India. Section 195 subsection 6, as was operative until new section become operative, was that if there is any chargeable amount, in respect of chargeable amount, information needs to be provided to the tax authority. What was intended under section 195 subsection 6 probably was that it is with regard to all the remittances that information should come to the tax authority, no matter whether the amount is or is not chargeable to tax. In what form will the information go? Will it be supported by the CA certificate? Will it be a self-declaration? That was pending, that was outstanding, that was not very precisely defined, but the intent was to secure information. But somehow that intention had failed, because 195.6 was also correlated to 195.1. So 195.6 also ignited only in those cases where the amount was chargeable to tax. In order to correct the situation, what has now been provided and which has created a near havoc in certain cases has been, new section 195 subsection 6 says that with regard to every remittance, information will need to be provided. We have rule 37BB, which has not yet been changed. As for this rule, only with regard to chargeable amounts that the certificate or the information will need to flow to the tax authority. So the section today says, with regard to every remittance, provide information, reporting needs to be done. The backup rule, which is intended to back up the section, says that only with regard to chargeable amount, reporting of information is necessary. In the midst of this, companies as also the remitters have been taking different positions. We have a situation where an extreme one, incorrect though, an extreme situation where a person wanted to transfer money from his one bank account to another bank account, and yet we came up with a suggestion that unless and until it is backed up by a CA declaration or a report, we will not allow the remittance. There are cases where, with regard to the import of goods also, certain authorized dealers have been asking for a certificate. At the CBDT level, Rule 37BB is in for a reconstruct. From what we learn from CBDT, their intention is not to capture or gather information with regard to each and every remittance, but until the new rule is finally notified and we have a prescription from the CBDT, certain difficulties are bound to arise right on the field. Our own view of the matter has been that it is only with regard to those items which are presently covered by Rule 37BB that reporting is necessary, but authorized dealer will have a say in the matter. Parties also might like to play safe. Difficulties therefore cannot be avoided. Let's look at some nuances of the Black Money Act. The suggestion from the President was that we ought to include something with regard to Black Money Act. So, in deference to the wishes expressed by the President, here are some slides on Black Money Act. Take for example the case of a non-resident individual. He might have been in India earlier. He has gone back to the States for 5 years. He was at the States. Thereafter he has come back. So he had some income which he had when he was a resident. He earned some income while he was a non-resident. during the period that he was a non-resident, he might have earned some income which is chargeable to tax in India. Say, for example, he might have been privy to transfer an indirect transfer of shares of a company, and some capital gain was chargeable to tax. While he was a non-resident, he acquired certain properties, and after he has become a resident, say in 2016 or 17, the properties which he acquired during the years that he was a non-resident come up for reporting here in India. Through the return of income which is furnished by the individual, information comes to the notice of the tax department that you are possessed of an asset which is located outside India. With this, there is likely to be some trigger of the provisions of the Black Money Act. We are told under that act that in the year in which information is received by the tax authority, the authority may have a power to inquire into certain facts, and if not satisfied with the evidence, they may consider the market value of the property as the income of the year in which information comes to their notice. On account of the provision that income may belong to the year in which information comes to the notice of the tax authority, the entire bar of limitation of 6 years or 16 years is sought to be done away with under the BMA Act, and that is where we have a very, very major concern. So this individual who in 2017 reports an asset, he might be called upon to explain as to whether he acquired this asset out of his income which was not chargeable to tax in India, or is it that he has utilized some income which was chargeable to tax in India but has not been reported in the return of income in India. What bothers the people, the taxpayers, is that if evidence is not available in order to justify, in order to provide a correlation, particularly if the asset was acquired years back, then there is a potential danger that market value of the property may come up for not only reporting but also taxation once the Black Money Act assessments are being conducted by the tax authority. A very major concern is with regard to the discretionary trusts which are outside India. While no one has a perfect, precise answer to various aspects of the matter, what we need to find out is, number one, discretionary trust, is there a likelihood that a trust itself may be considered to be a resident trust on account of the control and management which may be partially in India? If such is a situation, then in that case situation will be a bit alarming, because as a resident you were always required to report a number of assets. You were also required to report the income which has been derived, but let's assume for the time being that the trust in a way is controlled and managed outside India and qualifies to be a non-resident trust. Despite the fact that a trust may qualify itself to be a non-resident entity, what we need to check would be, a settlor could be a resident, trustee could be a resident, and when I say resident, resident and ordinary resident, or a beneficiary could be R and OR. Is there any obligation either on the part of the trustee or on the part of the settlor or on the part of the beneficiary, and what is the definition of a beneficiary will also become relevant. Now let's try to look at the reporting obligation which we now have in the returns to be furnished from assessment year 16-17 onwards. On the text of the Black Money Act, one doubt was whether the reporting obligation will trigger from AY 15-16 itself so as to coordinate with the Black Money Act, but from the FAQ what it appears is that the Black Money Act coordination will be effective from assessment year 16-17. In order to understand the principle, let's not get into AY 15-16, but admittedly there is a return for assessment year 16-17 and a trustee, settler or beneficiary has to take a view whether he needs to report any foreign asset. So far as settler of a trust is concerned, it appears to be fairly clear. Under the Normal Income Tax Act, the return as revised, the form as revised, namely that settler is under obligation to give information about the trust. So through the settler, information may come on the notice board of the tax authority. What is not becoming clear is the obligation of the settler limited to the year in which he makes a settlement, or is it a recurring obligation? So once a settler, always a settler, and he keeps on giving information every year so long as the trust is in existence. Second is with regard to a trustee. Trustee may be a de jure trustee, trustee may be a de facto trustee. Let's assume that we are concerned only with a de jure trustee. Is trustee under any obligation to report the details of the trust, even though he may not have any personal interest in the wealth of the trust, but since he might be holding the asset or he might be having signing authority with regard to some of the assets, notably the bank accounts of the trust, I would believe that trustee has an obligation to make a reporting in a year in which trustee himself is R&OR. Now this is something which might lead to some strange results. Say for example that there is a charity outside India. One of the trustees of that charity comes to India and he becomes R&OR on account of factors with which we are not concerned. In the year in which he is R&OR and submits a return of income, he ought to declare details about the trust with which he is associated. At this stage it is immaterial whether income of the trust is chargeable to tax in India or not. There is a reporting obligation which the trustee will need to fulfill. And if he does not report, despite the fact that no part of the income may be chargeable to tax in India, despite the fact that trustee or settler himself has no interest in the trust, number one, under section 42 BMA, there is an exposure to penalty to the extent of 10 lakhs of rupees, and if the default is a willful default proved to be so, as per one reading, there is also a risk of prosecution. There is also an obligation on a beneficiary. By the way the term beneficiary is being defined, there could be a debate. Beneficiary is defined as a person who has some benefit derived during the year. So if I am a potential beneficiary of a discretionary trust, but if I have not derived any benefit during the year, then probably the way the return form carries the definition of a beneficiary, I need not make a declaration or a reporting during that year. But if some amount has been credited to my account, or there is a distribution where I have received some amount from the trust, I ignite the reporting obligation and will be subject to the consequences which we just defined. Second aspect which a beneficiary will need to consider and which is tricky is, person has an obligation to report the details of the trust if we find that he has a financial interest in the entity. What comes up for interpretation is, does a beneficiary of a discretionary trust be said to have financial interest in an entity? Probable answer could be that a person who is a beneficiary, so-called, is only a chance beneficiary. He has no interest which he can enforce against anybody. He cannot therefore be said to have a financial interest in an entity, and on account of financial interest holding, he may not have any obligation to report. But it is only if neither the settlor nor the trustee nor the beneficiary has any obligation of reporting that the issue becomes relevant for a person who wants to keep himself away, for what reason we don't know, because if any one of them has an obligation of reporting, the information is received by the tax authority in any view of the matter. Supposing all the three of them do not make a declaration, but there is a good chance that on account of exchange of information, agreements which have been signed by India, come 2017, and you may start receiving some information. Requests for information may also be made, and through an external source, information may come to the notice of the tax department. We are also aware that the tax authority has by now downloaded quite a few websites where information about the account holding by India people is available on the website, and on the basis of that information, notices have also been issued to a number of persons. Tax department is bound to pursue that information further by asking various governments to furnish more concrete information, and it is in this background that one will need to take a view whether to report, whether to make a one-time declaration, or whether still continue to evade the tax department. One more aspect which I think has been troubling the companies is relevance of BMA to the expatriates. With regard to expatriate who becomes R and OR, a concession has been given, namely that if you are here on a student visa, employment visa, or a business visa, if you are having assets outside India, but the asset is not earning or yielding any income, there need not be a reporting. Mr. A might be here on an employment visa, but the accompanying spouse is not on an employment visa. The child is not on an employment visa. So first, so far as the spouse or the child is concerned, there is really no concession. Theoretically, anyone becoming R and OR, possessing a foreign asset, compulsory furnishing of the return of income, and if the asset is not reported, whether it is yielding income or not, there could be a penalty of 10 lakhs, and if a willful default, there could be prosecution. With regard to an expatriate, he may enjoy a concession, but he enjoys a concession provided he is holding an asset which is not yielding any income. So if he has a bank account outside or a security outside which is yielding interest income, then this asset he is under obligation to report. If he has a residential house which is not yielding income, with regard to that he may not have to make a reporting in his own return. Let's refer to one very important circular which we had from CBDT and which may have a direct impact on the indirect transfer of asset, the capital gains liability. To recap the provision, what we are told and what we see here on the screen is that if the parent company is holding an intermediate company known here as SPV and value is derived only from India or substantially from India, then when a parent company is transferring the shares of SPV, there would be capital gains tax chargeable here in India, unless of course treaty benefit is available to the parent company. Let's assume in this case that value of Indian company is $10 million. Let's assume that Indian company has by now already sent dividend upwards and $10 million are lying in the bank account of the SPV. Total value of SPV, the worth of SPV, can therefore be considered to be $20 million. When parent company transfers the shares of SPV to a desirous buyer, sale consideration is likely to be $20 million, on which there is a potential exposure to capital gains liability. Now let's suppose that prior to the sale of shares, what SPV does is that $10 million lying within the fold of SPV is upstreamed by way of dividend to the parent company. Question that comes up for consideration is that when a foreign company which is deriving value from India has dividend which is upstream to the parent company, can it be considered that there is likelihood of dividend tax liability here in India? Despite section 9 subsection 1 Roman 4, a probable view available on account of section 911 was that when SPV gives dividend to the parent company, source of income for the parent company is share held in SPV. That share is deemed to be located in India. Source of income for dividend income is also in India. Dividend will be chargeable in the hands of the parent company. Such was the view, which was a plausible view. At least it was a view on which a debate could arise. In order to put an end to this controversy, recently CBDT issued a circular whereunder it is now clarified that when there is upstreaming of dividend by SPV in favor of the parent company will not incur any tax obligation here in India. While suggesting this, the circular does also say that when SPV transfers dividend to the parent company in a manner that there is no transfer of assets in India, then there will be no liability to tax in India. The reasoning is declaration of dividend does not involve any transfer of asset in India, and therefore dividend income will not be chargeable to tax. On this particular slide, we are concerned with a narrow scenario. SPV has given dividend to the parent company. No change at all in the shareholding of any company. no asset in India has been transferred. $10 million lying outside India in the bank account of the SPV has been transferred to the parent company. The circular applies, dividend income will not be taxable. Your question would be, how does it have relevance to the capital gains income? It would have relevance if we consider two alternatives. If without declaration of dividend, shares of SPV were transferred, sale consideration would have been 20 million, on which there would be capital gains exposure. But if, as step 1, there is a dividend transfer first and thereafter there is transfer of SPV, sale consideration will drop down from 20 million to 10 million and the capital gain exposure will be only with regard to 10 million, the sale consideration. Now take this example. The facts might structure-wise remain the same. We have the parent company Exco, we have intermediate company. Intermediate company may have assets in India and outside India. That intermediate company FCO has certain accumulated profits, say to the extent of 500 rupees. There is a capital reduction whereunder Exco will extinguish part of the shareholding in favor of FCO. FCO will buy back, loosely called the shares, but not under a buyback scheme, but under a capital reduction scheme. Shares will be extinguished partly, and Exco will be receiving, supposing 800 rupees from FCO in lieu of the capital reduction scheme. We know that when there is a capital reduction by a company and that company has accumulated profit, then amount which is transferred in lieu of capital reduction will come up for deemed dividend taxation. So out of 800 rupees received by Exco, accumulated profit of 500 rupees will be considered to be the dividend income of Exco, whereas 300 rupees will be considered to be attributable to capital gains levy in the hands of Exco. Since dividend is involved, question does once again come up, will the circular apply? Can I say that because of the circular, dividend income is not chargeable to tax and capital gains exposure is with regard to 300 rupees? So let's go back to what the circular tries to say. The reasoning is, since dividend distribution does not involve transfer of asset in India, dividend will not bear any tax when it is distributed by the intermediate company. Does the reasoning apply absolutely to this scenario, or could there be a difficulty? Is this a case where there is no transfer involved, or is this a case where there is a transfer involved? Capital reduction is considered to be a transfer. It is transfer by a company, and but for accumulated profit presence, there would have been capital gains trigger even with regard to 500 rupees, because entire amount would have been received as capital reduction. So capital gains levy would have triggered. Does it mean that the benefit of the circular will be lost with regard to 500? 500 will be taxed as dividend income and 300 will be taxed as capital gain income. My own personal view of the matter is that, number one, circular appears to grant a concession even without there being a circular by virtue of section 914, quite arguable that dividend would not have been taxable. Secondly, even if we go by the language of the circular, this is not a case where a transaction between two foreign companies involves any transfer of asset in India when there is no external party on the scene. I would believe that the amendments of 2012 may be restricted to capital gains taxation and may not overreach the dividend income. Now this is the third scenario. This is a scenario where the parent company does not go in for a capital reduction scheme, but there is a buyback. Shares are bought back by AFCO from the parent company, and AFCO makes payment to the parent company. This is not a buyback under section 77A, obviously not, because we are talking about a parent company, but nevertheless there is a buyback. Doubts are arising whether a buyback is also involving capital reduction. Therefore, treat buyback at par with what we find in case of a capital reduction. Will same consequences follow in case of a buyback as in case of a capital reduction? My view of the matter would be that a buyback is distinct from capital reduction. In case of a buyback, reduction of capital is a consequence of a distribution taking place. It's not a case where there is a distribution taking place on capital reduction. We also have a specific section to deal with buyback of shares, which also shows that buyback is treated differently from a capital reduction. And hence in this case, no part of the amount paid to the parent company can be considered to be dividend. Since no part can be taxed as dividend, there is no dividend involved. The circular has no relevance. Circular is dealing only with the case of dividend. In absence of dividend, we find that the entire amount will come up for capital gains taxation. Refer back to this slide and read it with the amendment made by Finance Act of 2015. What we have is AFCO, which is holding a foreign company, Holdco. There is another foreign company, and there is a merger of one foreign company with another foreign company. Now when Holdco is merging with AFCO 1, all the properties of Holdco will be transferred to AFCO 1. Share of ICO, which is now held by Holdco, will now be owned by AFCO 1. So there is a transfer of an Indian asset from Holdco in favor of AFCO 1. Since there is a transfer, question of capital gain will come up. We find in section 47 that when Holdco is transferring the property to AFCO in the course of amalgamation, there is extinguishment of interest which Holdco has in ICO, because the shares which are held by Holdco in ICO are coming up for cancellation. Grace Collins case, Supreme Court, there is extinguishment of interest in a share, capital gain could be triggered. But section 47 has a specific exemption for amalgamating company when there is transfer of share by amalgamating foreign company to amalgamated foreign company. This is good enough. Now let's go a step further. FCO is holding shares in Holdco. Since Holdco itself is coming up for being struck off the register, because Holdco will not be in existence after the date of merger. There is therefore extinguishment of share held by FCO in Holdco. Since there is a transfer effected by FCO, because the shares are getting extinguished, FCO also has to worry about the capital gains liability. How do we look at this scenario and Section 47? Section 47 today says that a shareholder of amalgamating company will be able to secure an exemption provided that the amalgamation is in favor of an Indian company. Here the amalgamation is in favor of a foreign company. The amalgamated company is not an Indian company. So literally today we are faced with a situation where, so far as the shareholder FCO is concerned, Section 47 does not protect it. It is still chargeable to tax. There is an exposure to capital gains tax in India. Pick up this illustration, a very hard illustration, and coming up on account of the way Finance Act 2015 is worded. What does the indirect transfer provision today say? It says that USCO will be deemed to be having interest in an Indian asset if it is deriving value from assets which are located in India. USCO is holding 100% interest in UK company. UK company is having 100% interest in ICO. Entire value is derived from India. So far as US company is concerned, if it transfers the shares of UK company, there will be capital gains exposure in India. What is the basis on which one has to define whether US company is holding interest in an Indian asset? And we are told that if US company, with reference to the last accounting year of UK company, has more than 50% interest derived from India asset, then US company can be said to be deriving income from India, and whenever it transfers the shares of UK company, it will pay tax in India. This date, last accounting year, is known as the specified date in the explanation. Now let us presume that on 31st of December 14, UK company has revalued the shares of India company, and under IFRS it is, let's assume, required to bring up the shares at fair value. So what UK company has done, that Indian company is worth $20 million. UK company has recorded the asset on 31st of December 14 at $20 million. Value is derived only from Indian shares, but the book value of the shares in UK Co is $20 million. On 31st of December, value derived from India asset, therefore US company has an interest in the Indian asset. Let us now introduce a step that UK company transfers the shares of India company, not US company, but UK company transfers the shares of India company for $20 million, because that is the worth of Indian company, an UK company pays tax on this direct transfer, a direct connection with India shares with reference to $20 million. 31st of January 2015, this transaction is complete and we find that tax is paid. UK company has received value of $20 million, which is lying in cash in the bank account of UK company from 31st of January 2015 onwards. On 31st of March or May 2015, supposing US company transfers the shares of UK company, will there be once again a trigger of capital gains tax in India? Is US company holding any asset in India? On 31st of December 14, it was holding because ICO was under the banner of UK company. On account of that specified date attribution, US company is still holding interest in Indian assets through the medium of UK company. There is a provision in the explanation where we are told that you can examine or re-examine the situation on the date of transfer, that is on 31st of March 2015, provided that the book value of UK Co on the date of transfer exceeds the 31st of December value by more than 15%. In our illustration, book value was $20 million. It still continues to be $20 million. So if we go literally by the provision, once again we find that US company may come up for taxation here in India. The only intent behind taking up this illustration is to enable some corrective action to be taken before planning sale in the hands of UK Co, or maybe take some corrective step by which the fair value in the hands of UK Co is different, or maybe distribute dividend, whatever, but some remedial step will need to be taken in order to avoid such a dilemma or a trauma. Now let's look at China, the comparison, and how liberal are the provisions of the Chinese law with regard to indirect transfer. If we read through the provisions, then what we find is that it is only in a scenario in which indirect transfer is considered to be an attempt at tax avoidance or a near tax evasion that China will capture an indirect transfer of asset. Otherwise, on account of exemptions or on account of conditions, China will not be taxing an indirect transfer. Transfer pricing provision and the impact of an addition of section 92B subsection 2. Let us start with a scenario that a general rule is a transaction between two residents will not be chargeable as an international transaction. You require one resident and another non-resident in order to ignite an international transaction definition. An exception to this rule is created in certain situations. We are also told that an international transaction is one where a party is interacting with an associate concern. If you are transacting with a non-associate, then there will be no transfer pricing ignition. But there is an exception created to that as well in section 92B2. Transaction that we are talking about is hypothetical scenario. that ICO is subsidiary of a foreign company outside, which is an associate enterprise. Associate enterprise approaches the unrelated party in India and tells that unrelated party that if you can manufacture certain goods for us, we will buy back in entirety the production which you have. Unrelated party requires raw material for the purpose of making the goods. Associate enterprise tells the unrelated party that we will set up our subsidiary in India. Our subsidiary in India will make available the raw material to you at cheaper rate. You work on a cost plus basis with reference to the pricing of the raw material and transfer the goods to us at a certain value, which is cost plus marked up to the lower price which will be charged by the taxpayer ICO. The intention is to create two transactions between unrelated parties and thereby ensure that profit is getting shifted to the jurisdiction outside India. In order to bridge this gap, Section 92B2 now provides that a transaction between two Indian parties may also be captured within the net if it appears that the terms and conditions between such a transaction are settled by the associated company of ICO. So if the evidence were to suggest that the terms were largely finalized by the associated enterprise, which is a non-resident, then a transaction between ICO and the unrelated party will also be considered to be an international transaction, and there will need to be a compliance with regard to this transaction. Take up under the same section one more transaction. There is a global acquisition of business. Terms are finalized between EFCO 1 and EFCO 2, and we are told that on the basis of certain DCF formula, the businesses will be sold across the globe by EFCO 1 entities to EFCO 2 entities. A global agreement is between EFCO 1 and EFCO 2. EFCO 1 informs all its subsidiaries that this is the arrangement with which you need to comply. EFCO 2 informs all its subsidiaries accordingly, and we therefore find that there is a transaction in India where EFCO 1 transfers certain assets or the business to EFCO 2. Formula already decided by the two global arms. Will the transaction between ICO 1 and ICO 2 be captured by 92B2? Probably what we saw on the earlier slide may not apply here. What we find here is that ICO 1 has a transaction with unrelated party, which is ICO 2, but the terms are not decided by ICO 2 with associate concern of ICO 1. So far as ICO 2 is concerned, it is holding privity only with its own EFCO 2 head office. It is not holding any privity with EFCO 1. Similarly, so far as ICO 1 is concerned, it has no connection or privity with EFCO 2, but it has a privity only with EFCO 1. On account of that, 92B2 is not likely to apply. However, the transaction may get captured by 92B1 itself, because between ICO 1 and EFCO 1 there is an understanding An understanding can be considered to be a transaction the way it is defined. It is an understanding between two related parties and will be captured between APCO 1 and ICO 1 as an international transaction. Between APCO 2 and ICO 2, again, it's likely to be captured as an international transaction. A sweeping decision on beneficial ownership, and which will have an impact on a number of derivatives transactions. What we have here is a Danish bank. Danish bank has counterparties in different jurisdictions. Counterparty approaches Danish bank and it tells the Danish bank that with reference, supposing to a security of Unilever, we would like to enter into a transaction or an agreement with you. The terms will be that the base price of Unilever is X today. If there is any markup to that price, then that upside will be payable by Danish bank to the counterparty. If there is any downgradation, then the counterparty will make a payment to the Danish bank. If there is any dividend which is distributed by Unilever, then in that case dividend equivalent will be paid by the Danish bank to the counterparty. And for entering into the entire arrangement, certain premium will be payable by the counterparty, the customer, to the Danish bank. Danish bank, at its own option and not under any compulsion, will enter into a transaction, a step-down transaction, a hedge transaction, so that it will buy the security of Unilever in its own fold. This is to insulate against the risk. But if Danish bank believes at its discretion that it need not hedge the exposure, there is no compulsion that it will buy the security of Unilever. In our case, security which is sought to be hedged is bought by Danish bank, and Unilever is not a Swiss security, but it was only for an example. So the Swiss security, Switzerland company, while making dividend payment to the Danish bank, deducted tax at source. Danish bank claimed refund of the tax on the ground that between Swiss-Danish treaty, dividend withholding would be nil and therefore tax withholding may be refunded. Danish bank claimed that I am the beneficial owner of dividend income, therefore entitled to the refund. Question therefore which arose was, can the Danish bank be considered to be beneficial owner of dividend income which is sourced from the Swiss company? Federal Court of Switzerland earlier, about 3 years back, took a view that Danish bank is a beneficial owner because there was no compulsion on Danish bank to purchase the Swiss security on an hedge. Transaction between the two parties was in itself a proper contractual relationship. Danish bank ought to have paid amount to the customer even if it had not hedged its own exposure. But 2 months back, matter went to the Swiss Supreme Court and it has reversed the judgment of the Federal Court. Reasoning given by the Supreme Court has been that in the arrangement there was de facto obligation to pay dividend. All the transactions, including the hedge transaction, were interdependent transactions, directly tied to each other, bank virtually got itself relieved of all the associated risk, obligation to pay dividend income to the customer virtually deprived the Danish bank of freedom to apply the dividend the way it likes. By the time dividend was received, Danish bank had ceased to be the beneficial owner of dividend income. On account of this, one will need to rework. The decision is not yet finally out. It has been reported. The gist is available in the local language, but we have not been able to access the free English translation. But this is what the decision now appears to be, and it will create substantial hardship in a number of derivative transactions. Now let's look at this, and probably we might stop at that. Place of effective management. The entire India incorporate ought to be extremely careful about this, as also conservative about this. This is likely to affect the outbound investment more than the inbound investment. In terms of outbound investment, very likely, by invoking this provision, each and every foreign company might be put to a test if the headquarter is in India as to whether the place of effective management of the foreign company is it in India or it is not in India. Luckily, the test is we have to verify whether it is in India or outside India. If there is a US company, whether the poem is in UK or in Denmark or in US is not relevant so long as the place of effective management is not in India. For many years, with regard to the companies, we had a very liberal threshold. Namely that even if some part of the control and management of a foreign company is outside India, then a foreign company cannot be considered to be a company resident in India. Now from there, we are now coming over to say that if the place of effective management of a foreign company is in India, then such a foreign company will be regarded as a resident company in India. So, place of effective management of a foreign company. How is it defined? Place of effective management is situated at a place where key management and commercial decisions concerning the entity as a whole are in substance made. So what it means is that if I can pick up say two companies, Indian company has one subsidiary outside which is a pure investment holding company. Another is an operating business company which is outside India. Officer wants to know whether the foreign company which is an investment company is the poem in India, operating company, a business company is the poem in India. And he will be able to create a trouble if he shows that key management and commercial decisions of that foreign company. One therefore needs to find out what are the key management or commercial aspects concerning the foreign company on hand. For an investment company, key management or commercial decisions may be quite separate, requirements may be quite separate from the requirements of an operating business company. For an investment company, probably no decision itself may be taken except for avoidance of the risk and compliance. So one may need to find out whether an occasion at all has arisen for any key management or commercial decision and who has taken that decision. For an operating company which is on a cost plus model or a set business model, once again very little chance of taking certain substantial decisions at variance with what has been decided. But there could be some growing company or growth company where we may find that management or commercial decisions may be more trickier than in case of some other company. So first we need to find out what are the areas of key management and commercial decisions appropriate to the company which we are considering. After that, the officer will say that these key management and commercial decisions necessary for the entity as a whole are in substance made in India. Decisions need to be in substance made, so with a regularity they are normally being made in India by the people who matter. So substance will be involving regularity, and substance will also be involving effectively who makes the decision. If there are shadow directors who are on the board of directors of the foreign company, but they are effectively reimbursed and controlled in India, then in substance the decisions are being made in India and not outside India. But they should be the decisions which are appropriate to the entity as a whole. Now this aspect will be very relevant for certain overseas company where you find that regional controls are at different places. Take for example, and just for the sake of hypothetical illustration, without meaning anything, without naming or attributing anything, supposing that there is a Tata conglomerate, and Tata conglomerate has a very big company which is there in UK manufacturing vehicles. Now you may find that the foreign company, which is a foreign conglomerate in itself, is partly managed in India in the sense that the operational head of that part of the business might be sitting here in India. The finance head is sitting somewhere outside. The treasury head is sitting somewhere outside. The HR head is sitting somewhere outside. But the operational head, who has got some control over a segment of the activity, might be sitting here in India. He is not taking decisions for the entity as a whole. He is only taking decision, if at all, for a given segment of the activity with which he is concerned. So that shows the relevance of taking decisions for the entity as a whole. Now, who takes therefore the decisions is relevant for us to find out. And by and large what we find is, or the literature seems to be, that barring certain exceptions, benchmark rule seems to be that the decisions for the entity as a whole are normally taken by the board of directors of the company. And we therefore need to ensure certain do's and don'ts if we want to avoid difficulties for the foreign company and for the India head. What should I normally do? I should ensure that effective power of managing the business of that subsidiary or a foreign company is vested under the articles and the charter in the board of directors of the company. If I want to focus on the board of directors of the company, if we find on the charter of the foreign company that there is a long list of 50 items where only the shareholder can decide and no one else, there is a grave risk that the control management decision making is in the hands of the shareholder. If the charter of the foreign company provides that decisions can be taken only by a certain designated managing director of the Indian company, again there is a risk of POEM being tilting in favor of India. So balance the charter documents that the authority is vesting in the board of directors of the company, who thereafter, through the medium of competent and independent directors, take interest in the company and take decisions on behalf of the company. If this evidence can be shown, the chances are that we have a POEM which is not in India. Otherwise, there is a likelihood that a POEM may be considered to be in India. What are the consequences? Let us try to clear a misconception that I could be in trouble only if the foreign company is making profit, and I will not have any difficulty if the foreign company is not making profit. Consequences which can follow are substantial. Of course, if the foreign company is making profit, I could be in difficulty because I pay tax on global income in India, even if the transactions may be wholly outside India. But even a company which is incurring losses may also pose difficulties for me. If one foreign company becomes a resident company, then the transactions of that foreign company with other group companies which are outside India, the non-resident company, might come up for transfer pricing, because what were transactions between non-residents outside India will now become transaction between a resident and a non-resident. So there is therefore a transfer pricing ignite. As a resident under Section 9, I trigger certain withholding obligations in India which may not be relevant if I am a non-resident. So it is possible that I may not have deducted tax at source, but I now have withholding obligations. Expenditure can be disallowed, and though there might be a book loss on account of disallowance of expense, I might turn into a positive income which is chargeable to tax in India. If we are talking about a US company, then on account of a POEM triggering in India, the treaty benefit may be lost because a tiebreaker test cannot be invoked in case of India-US treaty, and a host of questions can arise on whether foreign tax credit will be available in respect of the transactions of this company. If I am governed by a presumptive tax provision in oil and gas sector, though by and large they will be the foreign companies, but if I lose the non-resident status, then many of the incentives which are available to me will also be lost. Black Money Act may now become chargeable, may now become applicable, because I will now be considered to be a resident company here in India. So we need to be very careful, plan the transactions, be cautious, be conservative, err on the safe side. Gone are the days where we find that everything will push through. Exchange of information is likely to be very, very relevant and active in the days to come, and hence there is a very grave need that we look at this on a very close basis. we have the BEPS sections flowing in. Anti-avoidance is going to be very, very strict. Exchange of information, multilateral treaty, awareness on the part of all the foreign governments with regard to curbing of tax avoidance is going to be the order of the day. A number of changes are expected as a follow-up of the BEPS sections. So here is a time where one needs to be careful while giving an advice, while planning a particular transaction. Some aggressive advice might not only land the client into trouble, but can also lead a professional into a trouble. And that's where fascination of all the one-time declarations and handling of the black money transactions, we the professionals need to be quite careful without putting down the advice, without communicating the advice. Because if I do become aware that there is a client who approached me, that client has confided in me certain transaction, he doesn't thereafter go in for a declaration. 2020, as a witness, I could be called and I could be asked, are you aware of any such transactions having been undertaken by the client? An advocate may have confidentiality available, a chartered accountant does not have. I will be under an obligation to make all these facts clear to the tax department, and if I don't, I personally may run the risk of not having disclosed information to the tax department. It's not as if that this is something new to India. If we go back to US professional who is conceiving the scheme, and if he believes he is aware that this is a potential tax avoidance scheme, voluntarily he is under an obligation to make certain disclosures. But here we are not talking about a voluntary disclosure, but let's be very clear about our obligations as a witness. If in the process it appears that a person who was willing to make a declaration, but I am the person who advised him that please keep away, that's going to be a greater danger still. But then we will still continue to carry on our practice, but we will do it in a manner which is expected of us. Thank you very much.
Thank you, Pinakin Bhai, for covering such a wide spectrum of topics along with all the issues and several examples. I'll request Manish Sampath to make a few announcements about the upcoming programs and also propose a vote of thanks.
Thank you, Raman. Before I go on to propose a formal vote of thanks, a couple of announcements of the Society's forthcoming event. First, the paid ones. The International Tax Committee has organized a program on AAR on 17th of July at the IMC. International Tax Committee also has organized a workshop on the Black Money Act on 1st of August 2015 at the MC Gia Hall. The Accounting and Auditing Committee has organized a program, an intensive workshop on internal financial controls on 7th and 8th of August. The lecture meetings, the two lined up lecture meetings are on 29 July is on filing of income tax returns by Ganesh Rajgopalan and Ritvik Sanghvi. And next on 12th of August, Kushru Pantaki will be speaking on statutory audit finalization under Companies Act 2013, important matters. Now, coming to propose a formal vote of thanks. It's always a matter of great pride and honor to propose a vote of thanks to a person of stature of Pinakin Bhai. Sir, the past 75 to 90 minutes of your presentation speaks about the depth of your knowledge and the practical experience that you have gained in your profession. Sir, thank you very much for sparing time and enlightening us. Friends, please join me in proposing a very hearty and well-deserved vote of thanks to Pinakin Bhai. Thank you.